months, and first time down in Florida in about 18 years. So it's nice to come down. Great to meet a bunch of new people, but got a short time, so I'm going to dive right into it. The company is Hemisphere Energy. We're an oil company. We are a Canadian oil company, and been working with Michael here over the past year. So just to get into sort of our guiding principles, the pillars of the company, we like to keep things simple. Be a strong company, great balance sheet, make money, and why can we do that? What makes us unique? So when we say simple, we look for conventional oil pools that were usually discovered in the 70s or the 80s. The technology back then was a lot of drilling vertical wells, but in a lot of cases they left a lot of oil behind. So we come back in, try and capture these pools where maybe somewhere between 5 and 10% of the oil has been taken out. We come in with newer technology, nothing crazy. It's not proprietary Hemisphere or anything. It's horizontal wells, and then we have been applying a enhanced oil recovery technology, which is a polymer flood. And it's pretty simple. I'll talk about it later in the presentation. And we do that in order to maximize the recovery of the oil that we know is there. We know it's there, we can map it. How do we get more of it out? How do we get it out for as cheap as we can? Balance sheet has never been in a better situation. We're debt free. We're building cash right here through Q4. We have minimal decommissioning liabilities. So all that means is all that free cash flow that's left over can go to growth and go back to shareholders. Make money. We are the highest free funds flow yield of our peers. I'll have a slide that shows that. We pay a quarterly dividend. We started about a year and a half ago when we paid our debt off, and we buy back stock. What makes us unique? Why can we do this? It's because of the type of assets we have and the way that we're developing them with the polymer flood gives us a really low decline. The last couple of years, it's basically been flat. As we move forward, we're going to be in that 5 to 10% decline rate. Compared to the industry, that's fantastic. Again, it just means that the money that we recycle back in for CapEx is there for growth, not just to stay flat. So where are we? On the map, southern Alberta. For those of you that have been to Alberta or into Calgary, into the mountains, we're about a 2-hour drive from Calgary, so it's easy to get to. The area has been producing oil since the 50s, so it's an area that's well known for production. We trade in Canada, we trade in the US at the OTCQX. And over the last number of years, we've been targeting the US retail market. We've grown our shareholder base here from about 5 years ago, we're probably about 5%. Today, we're closer to 35% on the US side. Shares outstanding, about 100 million. Insiders, we own almost 15% now. Gives us a market cap, so a couple of good names to remember, or even our enterprise value, because we're sitting on cash, but 125 million. So I'll bring that back up as we talk about our cash flow and as I talk about our reserve value. On the bottom there, we are producing currently 3,300 barrels a day. So that's our production, and we are 99% oil. So we are an oil company. Give you a sense of the type of numbers we're looking at. So for Q3 this year, those numbers just came out a couple of weeks ago. We were just over 3,000 barrels a day, about 24 million in revenue, almost 16 million in field netback. So that's after our operation costs and our royalties. So cash flow, and I'll use the term cash flow because everybody understands it. The accounting term is the adjusted funds flow. At least in Canada, that's what we use. So almost $12 million of cash flow for the quarter, or almost $42 a barrel. So fantastic quarter. Annualize that, you get a sense of what our yearly cash flow in that sort of $40-50 million range. I will say these are all Canadian numbers as well. We report in Canadian numbers. CapEx for the quarter was 8.7 million. It was our biggest quarter for CapEx for the year. Summertime is the best time to do business out there. The weather's great, the days are long, and we managed to probably get about $1 million worth of efficiencies by drilling and lumping our whole drill program into one big summer program. A couple pictures on the bottom just to give you a sense of what it looks like down in southern Alberta. Here's the slide I mentioned before for the free funds flow yield, and as well on there in the red triangles are corporate liabilities, so debt plus your decommissioning liability. And then it's in the fine print down below, but 20 of our oil-weighted publicly traded peers. So, and using Q2 numbers, annualizing those numbers, and taking CapEx for the year, we get the yield. So we're highest yield of all of our competitors, and we have a great liability, low liability as well. A few others that are as low, but it's something you got to watch for. Certainly debt side, but also future decommissioning. Just means, as I said before, it leaves more money for our shareholders and for growth. So we'll talk about the assets themselves a little bit. So the two pools we've been developing over the last number of years. We've drilled horizontal wells into it. We've now implemented this polymer flood throughout most of the pools. We're continuing to drill and expand these pools, and we'll do so in the next few years. But we're really going from development or aggressive development more to cash flow harvest mode. So these pools now will produce for the next 15 to 20 years and be able to provide the company with predictable cash flow that then we can use, not just to continue to sustain production here, but also to use for us to grow in other areas. So what is a polymer flood? It's not something new to Hemisphere. It's been used for decades all over the world. Lots of companies do it. And it's really, as we said before, it is a way to get more recovery of the oil you already know is there. You can't use it in every reservoir. It doesn't work everywhere. But if you have the right geology, the right reservoir, the right oil characteristics, it's a great way to recover more of that oil. And all we're doing, in this case, there was already a water flood, so we were re-injecting the water that we produced back down into the reservoir. But during COVID, we did an analysis to see if adding a polymer to that, how successful that would be. And we were blown away how it modeled. At $40 oil, it was extremely economic. So we kicked it off during COVID, and we had it up and running in 2021. When prices were already back into the $60, $65 range. So it's been a huge step forward for us. And you can see that the diagram on the bottom there is a little block diagram. You can see the surface, you can see where our wells are drilled down, the horizontal wells. There's 3 wells there, you guys see there. Drill them down, they're about 200 meters apart. We drill about 800 meter length, and then we turn the middle one into an injector. That's where we inject our water and our polymer, and over time, it builds this wall of oil that it pushes over to our producing wells. So a successful polymer, we get an increase in oil production, we get a decrease in our decline rate. So, I mean, these wells aren't sexy, they come on at somewhere between 50 and 150 barrels a day. What is sexy is that they're still 50 or 150 barrels a day, 5, 6, sometimes almost 10 years later. So that is the real advantage of having these type of assets. And ultimately, why we do this is for the increase in overall recovery. Why go explore for new pools and take a high risk on exploration when we know that this oil is here? So here's the polymer advantage, what I was just talking about, but looking at it graphically. So if you take just an average oil and gas company, typically they decline about 30%. And if you look at this graph, that represents that. So there's a wedge of drilling for one particular year. They drill a bunch of wells, they spend a bunch of money, and they add some production. But then if you look at those same group of wells 2 or 3 years later, they're producing significantly less oil. And there's nothing wrong with that. These companies make tons of money. They're all, it's a good business. But when you look at Hemisphere's, our declines and our well programs, here's a program here in 2019. We drilled, we have our typical decline, we put in our polymer floods, and here's that same wedge of wells producing as high or sometimes even slightly higher than they were 2 or 3 years before. So that is a huge advantage for a company to have these type of assets. This just digs into it a bit deeper. If someone wants to pull me aside later, we can talk about it in more depth, but this is the production of 40 wells that we drilled between 2014 and 2019. You can see as we drilled more wells, our production went up. Here's where we implemented the polymer flood in the 2 different pools we have. Now, after converting half of our wells from producers to injectors, so we got half as many wells producing oil, our production is higher than it has been at any point in time. So again, just illustrates the data behind the polymer flood. What does this mean corporately? What this means is that we have this asset here that we still have some growth in it, but more importantly, we've got years ahead of us of fairly flat decline and lots of cash flow to come out of here. So it means when we're spending our money on CapEx and in new areas and making acquisitions, we're truly growing the business. So I mentioned the enterprise value around 125 million. We talked about the cash flow around, call it 40 million for the year this year. So we're trading in that sort of 2.5 to 3 times cash flow, which is fairly typical for the industry. But when you compare it to our reserve value, because of the type of asset we have these great reserve values. So we're trading at quite a discount to our PDP reserves, which is our blowdown. If I didn't drill any more wells today, just let our wells produce out, there's another 8 million barrels or $230 million. Proved reserves is typically where we tend to look at. For most companies, that means that the auditors are about 90% confident, not only in the wells that are producing today, but the future wells that can be drilled. So for us, that's 12 million barrels over $300 million in PDP or proven value discounted at 10% before tax. So good opportunity there. Here is a graph showing those same 20 companies that are our publicly traded peers and where they trade on their EV to their different reserve categories. So there's a lot on this map, but really if we focus on the black bar, that is the enterprise value to your PDP reserves. And you can see most of our peers are trading at that 1 times their enterprise value. They're trading around their PDP value, whereas we're trading down here. Now that being said, we trade at very similar cash flow multiples. It's the difference in the asset. In the market right now, it's very laser focused on cash flow multiples. And I think those are things that change. Market's always changing. But again, you want to look for those companies with that deep value, the ones that really do have those great assets underlying that cash flow. So talk a little bit about our return to capital, what we do. So we have a quarterly dividend. We started that about 18 months ago. We pay 2.5 cents a share per quarter, and we've paid out almost $18 million to date. Our next dividend is coming up here. It will be paid on December 28th to shareholders of record on December 15th. This is completely funded through our free cash flow, and in today's market cap, that's about an 8% yield. So good looking there. Special dividend. Special dividends are special. They don't happen all the time. In our case, what we've told the market is if we don't have an acquisition in our crosshairs, if we don't have a plan to ramp up production, but our cash is building, we will, from time to time, look at a special dividend. So earlier this fall, we had that scenario. We paid out a 3-cent special dividend to shareholders back on November 1st. And our normal course issuer bid, which is the share buyback program up in Canada, it's not something that's set. It's not set on a daily limit or a weekly limit. It's more opportunistic for us. We look at it and typically take advantage of days where, and we seem to have more than we like, but days where oil's down $2, $3, $4 a barrel. We get quite a few of those now and then, and shareholders tend to panic. And we're able to take advantage of that in the market, grab some stock, and then we cancel that stock at the end of the month. Remaining cash flow, so you look at a year like 2023, so about 40 million in cash flow. We had about $15 million in CapEx. We had another $10 million for the base dividend, the quarterly dividend. So we were still left with some fairly significant free cash flow. That's where the special came in. We're building cash today. And we'll take advantage of opportunities where we can see either an acquisition or look for ways to build the company. So that's the summary. We've talked about the dividend and the NCIB. We've talked about the high free funds flow yield. All reasons to buy the company. Why can we do it? It is truly, when you boil down to it, it is that low or ultra low production decline. That's what makes the big difference in a company like ours. Balance sheet has never been better. And then the last thing here that I haven't talked about is, where do we keep going? What do we do? How do we keep growing the company? So this is something that we have told the market. We haven't said a lot about it yet because we're still working on a few land deals. But we have picked up 10 sections of land for about $1 million or a little over $1 million, and which would equate to around 7,000 acres type thing. And we like these lands. They're crown lands. That's what we call the government land in Canada. They have no liabilities with them. The royalty goes to the government, so you understand what it is. There's no other royalties attached. There's no liabilities attached to it. We see the same characteristics in this play that we saw in our existing asset. So there's a bunch of old verticals. They produced oil. They took out, depending on the section, somewhere between 5 and 10% of the oil, and the rest is left there. So our plan is in 2024, as we finalize permits and applications and all that, we'll be a little more in January, understand our timing a bit more, but we're going to go in, we're going to drill this play, we're going to test it, we'll drill horizontals into it. If we get what we expect, we'll follow up in those same wells with a small pilot polymer flood. And the plan is to, hopefully we see something similar to what we've got down in Atlee. So those are the type of things we're looking at. This was a little more grassroots. It wasn't buying production, wasn't buying another company or particularly an asset. It was more through crown land sales. But these are something that we look at as well, and should be exciting. So watch that through 2024. I would say that's probably our biggest catalyst as a company. The other catalyst for our industry in Canada is we're getting our first pipeline, heavy oil pipeline, to Tidewater since the 50s. That will be on stream in Q2, we're being told, and that will significantly help our pricing. We're already seeing it in the futures market on the Canadian pricing, and from today's price, it could add close to $10 a barrel to our pricing from today. So that's it. Thank you very much.
How do you get your oil into the pipeline? You have to truck it in?
So in our own area where we produce the oil, everything is pipelined to 2 central facilities where we get our oil to sales quality, and then truck takes it from our facilities. It's about a 45-minute drive to the terminal, and we sell our oil there, we get paid, and 95+% of our oil would go down a pipeline down to Montana and is used in the 3 refineries down in Montana.
So you don't have to book space on the pipeline?
No, well, yes you do, but because of our size, we never,
Right.
We're a great swing producer. We've actually teamed up in a marketing group that they represent about 100,000, and some of them are bigger players, so they love a small company like us because we can fill a gap here or there, and it's quite helpful. And it's a win for us. Typically it means we end up getting an extra 50 cents or $1 a barrel to be able to help that out.
The other question I had is, what are your net backs?
So, average, I would say we're looking more around $45 to $50 a barrel. Q3 was a fantastic quarter and was $56 a barrel. So
yeah, that was pretty high. That was with a $90 average sale.
Well, there it is there. So the average revenue was $86.57 per barrel.
So you've got a swing.
So why that is really in that price range. The royalties to the government, the Alberta government, would be about 20%-ish, and it does. It scales. It goes up with price and it goes down with price, which is a natural hedge in Canada, which is great. The big part of it though is our OPEX. For a heavy oil producer, we have phenomenal OPEX.
Price out there, right?
It's like $13 to $14 a barrel. Yeah. But that's the one of the few things we can control. As you know, in our business, you can't control the price that you get, other than a bit of hedging now and then, but you know, the one thing we can control is our costs. Yeah. Yes, sir.
I'm glad you have that chart up, because I was going to ask a question, point out. Adjusted funds flow in the third quarter, 12 million, capital expenditures of 9, $3 million excess free cash flow, and you declared a special dividend. Since then, average production's gone up to 3,300, up almost 10%. So you got to assume adjusted funds flow is probably going up. Your CapEx is going to go down because you did most of your drilling in this quarter.
So you're almost right. So yes, production's up 10%. Pricing is down.
Yeah.
Probably a little bit more, probably about 12%.
But either way, you're going to have a lot more than 3 million.
Oh, yes.
Funds flow in the December quarter.
Very little capex. So we were done drilling. What we will have is a bit of prep capex for next year. Like we're already starting to buy some pipe and some tanks and all that kind of stuff in preparation for Q1 and Q2. 5 minutes. Perfect.
So,
You know, I don't know. I mean, it's something we talk about at every board meeting when we do have it. You know, it really depends. Like we're seeing some, and I'm putting a lot of time in on a lot of M&A type opportunities. Whether that's M&A, sort of the traditional M&A, something's for sale and let's put a bid, or whether I still lump into I'm mapping up a bunch of these great areas that have bypass pay and no one else owns this stuff now. Like the government. So in Canada, you lease land for 5 years. And it cycles back. So we've got quite a few areas that pricing was terrible when the companies leased the stuff out. They didn't end up doing it, and we're seeing it come back into the open market. So it just means as a geologist, I got to spend more and more, and the rest of our team, there's a lot of opportunities out there to map and take advantage of. So it's a long way of me saying, I might be finding some areas that I think I can get an even bigger rate of return than, you know, like the idea with the special is, I still think I can do better if I've got the right growth asset. I can make more money on the capital gains, and it's taxed better. However, if I can't, if I don't have that in my sights, then I'll give it back to you, and you take that money and you find a place to put it.
maybe a better question for me to ask is why a special dividend instead of raising the dividend?
Because we're small. And I think we want to be cautious on raising a dividend. I never want to bring that dividend back down. So we'll be extra cautious. We've seen a couple of, we don't have many peers anymore in our business in Canada. There used to be 70 companies like us. There's like 5 now on the smaller side. 2 of them had to lower their dividend when oil got back down into the $70 range. That did not go over well.
Yeah, stock gets killed.
Just got killed. Absolutely annihilated. Yeah.
Do you think there's gonna be more M&A in the mid-tiers?
Yes.
And if they do, they're gonna be spinning off more of these secondary properties for you to look at?
Yeah, I think definitely we're going to see more M&A. And then we are starting to see some of those companies that did a bunch of M&A a year or 2 ago starting to find and rationalize, and
Too small for them to.
too small, or maybe they don't see an opportunity in it. But you got to be careful on those. A lot of times they're selling the ones that have a huge amount of wellbore liabilities, and it could be just an anchor. So you got to spend quite a bit of time doing your homework. But yeah, I think since August we've seen an unbelievable amount of opportunity hit the market. We haven't seen a lot of it close yet. There's only been a couple of deals close, but the amount of product that we're actually seeing hit the market is the highest I've seen in quite some time.
Well, the shale, Texas is pumping like mad, 7-year all-time high.
Yeah, I wish they'd hold off a little
Well,
bit.
that's the thing. So if you talk about OPEC, where they say we're gonna cut 1 million, but the price is down $6, the math doesn't work.
Yeah, I think I do get worried when you get into periods of time where U.S. production is at record high and the Saudis are cutting another million. But there is, and just economies are not exactly going full bore right now.
1 minute,
either.
sir, 1 minute.
Yeah, thanks. But I still have a cautiously bullish view. Maybe not, you gotta be cautious in the near term, but you get another quarter, these things can switch so fast. And we're using 103 million barrels a day. And so maybe we've got 3 million in spare capacity right now. I mean, yes, that's good, but we could use that up in a hurry too. I mean, and there's so much going on in the world right now that things can turn on a dime. So run a good business, control what you can control, and take advantage of those times when they
Do you
spike
think
back.
the cash flow multiples are gonna stay this low?
No, I don't. That's why I get up every morning. I don't think they can stay this low. We will see that eventually. I wish I knew exactly when, but
It's phenomenal for investors right now, to look at these cash flows.
yeah.
Thank you very much.
With more than 6,000 small and micro-cap companies listed, if you're looking for the next Apple, then Channel Check truly is your trade. It's an investor community where you can access independent Wall Street research, advanced market data, balanced news, corporate videos, and podcasts. You can even register to attend in-person Meet the Management Series lunches, and to be part of the preeminent annual Small and Micro-Cap Investor Conference, NobleCon. And here's the best news. Since Channel Check is sponsored by the featured companies, premium membership requires no investment. It's absolutely free. So check it out. Log in today. Find out why Channel Check is North America's leading source of research on the companies that just may change the world.